Awesome. All right. Good to see everyone. I see a lot of familiar faces and names and some new names. Would love for everyone to, if they can, come off or at least turn on your videos. This whole time I'll be talking to you and just hoping that what I say resonates with you. And if I can't see your face, it's really hard for me to tell. Let's get started. I just have two quick questions. Wanted to know where people are calling in from, joining the Zoom from. If you could throw it in the chat, I'll just kind of review where people are coming in from and see how this is all going. Cody joining from Pasadena. He doesn't have to throw that in. What's up, man?
Hey.
Gina just down the street in Venice. Let's see what else we have. Peru, Berkeley. Wow. Oh, Rio. Amazing. We have some brasileiros in there. Love it. Okay. The second thing I wanted to ask, and this is more selfish because I don't often get a chance to get a lot of smart people together who think like me. What is everyone watching TV wise? I feel like everyone here is the type of person that is go, 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 go. And I want to make sure yes, beef. Holy shit. That was exactly what I was going for. I wanted to make sure people heard about this show. Beef. If you haven't seen it, it's incredible. If you happen to be Asian American, and it's amazing. But even without that, what a great show. New York City. What else? American Auto and Rabbit Hole. Okay. All right. I just wanted to make sure people we're starting to lean in and not too nervous about talking about fundraising. I know it's a not the most fun topic to talk about all the time, but we're going to be jumping into stuff that I think is going to be really helpful. We have Ellie Wheeler joining us a little bit later, but we're going to start in the first 20 minutes, really focused on some lecture topics and interaction with you. So let's get into it. As housekeeping, I've already asked you guys, turn on your cameras. Realize that the Zoom chat is open. The Zoom chats in all of our events tend to be a great place to spend time. Paige and Jonathan from our team are in there asking questions. We'll be looking at that for where we'll be answering questions, both myself and with Ellie Wheeler. And then just know that anything we talk about, feel free to share on social. Not everyone gets to join, but the whole point of these workshops is to help the founder community better understand how to fundraise. And last but not least, all the workshops that I do are very interactive. So if I ask for volunteers, I recommend you guys volunteer. The people that interact with me will end up getting the most out of this. And just to plant a seed for what we'll be doing in the future, start thinking about your business, the nuts and bolts of the businesses that you guys run, the ins and outs of it, because we'll be doing an interactive exercise on your business and how we think about whether or not it's venture backable or not. Okay. There are a lot of familiar faces out there. So some of you have been to some of my workshops, but a lot of new names. I will spend just 2 minutes giving a little bit of background on me. And I'll tell you in a second why. Started my career at MLB.com, where I was ended up being the head of new media products. Was a venture capitalist at Greycroft for about 4 years before getting into venture-backed startups. The last one that I ran, I was co-founder and CEO of a company called Tape, raised a couple $1 million, had a small exit in 2020. Yeah, 2020. God, it's been so many years now. And after that, transitioned to this line of work, actually partnered with a company you've heard of, Silicon Valley Bank, to become their internal fundraising coach for a little bit before launching my own thing, Adamant, which is focused on making fundraising easier and more accessible for as many founders around the world as possible. We do that through a lot of free content, workshops. One that I love plugging is my podcast, Funded. But this whole background is not meant to necessarily credential me or make me feel better about myself. It's really to give you guys context for the advice that I'm about to give. I do that because I find that in the game that we're playing right now, startups, venture capital, the things that you guys are trying to get smarter about, there is so much advice that is given as sound bites without context. And I think without context, it can be very dangerous to follow advice. So the first point to make is, whether it's me or anyone else, I want you guys to think about the background and the context in which the person giving the advice is giving their advice. All the advice that I give is based on my own experiences. So just think about whether or not it matches your experience. And the second thing I just want you guys to know is that you should be digging deeper and deeper into any bit of advice that you get, so you get to the first principles and understand it yourself, so that you can be creative when you get out there trying to fundraise, trying to run your startup, et cetera. And the example that I give around this every single time, I apologize to the people that have been to my workshops, but I always talk about this piece of advice, which is around data rooms. And if you read these two tweets, they are in blog posts, they are related to this idea of when a founder should share a data room during the fundraising process. On the left is Andrea Funston from Basecamp Ventures, and on the right is referencing a blog post that Mark Suster from Upfront wrote. And if you go into the details of those two posts, on one side, Andrea says, I love seeing a founder that right when I meet them is ready to go with the data room, shares the data room right away. And in the blog post, Mark Suster writes, he talks about essentially never sharing a data room if you're a founder. Both are kind of extreme soundbitey messages, but how could that be? Like, how could two well-respected VCs have the exact opposite pieces of advice? Well, the reality is, if these two investors actually broke bread and talked about this topic, I bet you they would agree on most things. It's just the context and the flavor of how they give this advice on things like social media. So that's the preamble to all of this. A lot of my workshops talk about very specific functional things to do when you're fundraising, how to start preparing to fundraise, strategies around that. In fact, next week which I'll talk to you about, we'll talk about how to use AI, how to use ChatGPT to supercharge your processes and your efforts to prepare. But today's focus is around a series that we've called RUVCB. And RUVCB stands for Are You Venture-Backable? So I think a lot of you have maybe heard the term venture-backable. Some of you maybe have heard this in not so fun situations where people say, Nancy, I love you, love what you're doing, recruiting. I'm not sure you're venture-backable. Gabriel, I'm not sure what you're doing is venture scale. What I wanted to do was first see if there are any volunteers that have experience with this or insights around the term venture-backable and what it means to them. So I would love to see a volunteer talk about what they think it means to be venture-backable. But if there are no volunteers, I'm not scared of cold calling people. So in case anyone wants to talk to me.
I can give an example, J.A.
Love it. Cody.
So we run a medical practice that's focused on blood pressure management. If we were just doing a brick and mortar medical practice, I would say that's not venture-backable. But we're delivering it only virtually. So we use telehealth and remote monitors, and we're building software around it to be more scalable about how we deliver it, meaning like not having to use as many doctors. So we're going to leverage our software to treat, millions of patients versus hundreds of patients. So I think the one example of just the medical practice is not venture-backable versus what we're doing is venture-backable.
Okay, let's stick with this for a little bit longer. On that first part, if you were just launching physical clinics that are focused on cardiovascular health, talk to me about what does that mean to a venture capitalist? Are they saying that you're a bad business? What are they saying about a company that is focused on brick and mortar?
Yeah, not necessarily a bad business, but it would require a lot of capital to grow. And it's you would just need to, put in a lot of investment around just the real estate to grow it, and it would be, yeah, not venture backable, I guess.
Okay. No, that's great. I'm gonna pause right there and see if Gabriel has a different perspective on that. Gabriel, share a little bit about your perspective on the idea of venture backable, maybe as it relates to you.
Sure. Yeah, so I can I can actually speak to it as a kind of a tech powered brick and mortar play. The funds I'm talking to, they want to be able to return the fund, right? They need to see those outsized returns, which you can do. I mean, you can do it in a number of different spaces, but you have to be able to show the picture or paint the picture of how do you go from 1 million ARR, 10 million ARR, 100 million ARR. We work, they're a real estate company, right? But they had amazing venture back returns for a lot of investors. For some, maybe that came in later, not as much, but yeah. I think they want to know that given the statistics around venture investing, that you can return the fund or beyond.
So Gabriel, let me push you a little bit further, because what I want everyone here to do is not rely on buzzwords to make sure that you understand the mechanics of this. So tell me what you think about when you say return the fund, because that is something that you'll hear venture capitalists say, you'll see it in tweets and reports. What does return the fund mean to you?
Sure, that if I were on the venture side, that kind of after dilution, depending on the round that I'm coming in, that the exit potential has the ability to give me a return that is the size of the fund. So if I'm, we've got $100 million fund and I'm making 100 investments, right? I likely need for it to return more than 100x, because I'm going to get diluted with subsequent rounds, right? So sort of in that, there's math behind it, right? But that's the general idea.
Love it. Okay. Wow. Very good. I expected you to falter a little bit more than that. Let me show you a few slides that I wanted to make sure we underlined. Cody said the words, not me. And I think it's really important that everyone hears this in this presentation, because the point of RUVCB, the point of going through this information, is not just to get you to not do your business. It's to really make you understand what it means to go raise capital and the story that you need to tell. And I by no means want you to twist and turn and distort what you're doing in order to go raise money from venture capitalists, because, by the way, I love bootstrap businesses. Bootstrap businesses that make money right away, are profitable, and can create a great life for yourself is incredible. I've run both. I've run venture-backed businesses and I'm running a bootstrap business. And for the right reasons, and I underline for the right reasons, both make sense, but it has to be for the right reasons. So just make sure that when we talk through this and we look at the mechanics, if you decide that you're not venture-backable, awesome. Then let's talk about other sources of capital. Let's talk about how you become profitable. But we are not saying that if you're not venture backable, you are a bad business. And then Gabriel did a great job of kind of outlining this. Well, what does it mean to be venture backable? What does it mean to return the fund? What does it mean to be a venture capitalist and use the lens that they have to decide, what they should be investing in? The basic mechanics of venture capital is a high risk, high reward, high return probability business. In that, if they are looking at investing in DJ and they look at Ruben and they look at Jason and Miriam and they say, what is this business capable of doing? What is the potential in the future? If I look at DJ and he's creating a crazy new AI product that could revolutionize the world in 10 years, and we invest that $10 million, and God, I can see a world where this is the next Amazon. But then I look at Jason, and Jason Sharp is running a business where it's great. I mean, it seems to already be profitable and could probably exit for $100 million. Like, wouldn't we invest in both those companies? I think the idea is that what you need to understand is that every bet that they make has to be that opportunity to be a DJ style bet, because if they don't, it just doesn't fit the business model. Jason's business could be amazing it just doesn't fit the business model, because even if he hits a home run in his business, it doesn't have the probability of returning the fund the way Gabriel talked about it. Okay. The big thing to note here is that when we think about what is important for a venture capitalist to understand, they need to believe two things. They need to believe, one, that there is massive potential, and two, that this team can do it. If I were to distill everything when it comes to looking at an early stage company, if it boils down to those two things. Obviously, the devil's in the details, but if we concentrate on those two things and your ability to communicate one and two, you will be in a much better position to raise money from a venture capitalist. Now, if you're thinking about, are you a great team? And you check that box, awesome. I think most of you wouldn't be here if you didn't think number two was true. Number one is where we really need to understand whether or not your company actually has the potential to be a venture-backed business. And Gabriel actually jumped into this a little bit, but I'll give you some of the ranging sort of multiples that VCs are expecting when they talk to you to be able to underwrite to say, do I believe Philip is a VC backable business? Well, when we were talking to him, if he's raising a Series A, can I squint and think, could this be 10x bigger? Could this be 30x bigger than it is today? If you're pre-seed and you're just an idea and you're raising at a certain valuation, I need to believe that you're running a business that could be 100x the size. And I am going to be mindful of time because we're going to bring Ellie in a few minutes because we want her perspective on this. But the discussion that I want to have with some of you live is a little bit about, what investors need to believe in your business. So I'm not going to ask, actually, I'll ask for volunteers. I'll wait 5 seconds for someone to volunteer. Otherwise, I have my cold call target. Does anyone want to talk to me about their business? Raise your digital hand. Okay, that's fine. Arthur.
Sure,
Oh, who's that? Oh.
it's Jared at Thrilling Foods
Okay.
that
Jared.
just spoke. I don't know.
Great. Can you tell me a little bit about your business?
Sure. Thrilling Foods is a food company. We make the best plant-based bacon on planet Earth. And in the future, we've got a bunch of other products that do as well.
Amazing. Okay. Have you raised money? Are you about to raise money?
We've raised about 1.3 over the life of the business. I expect to raise about a $3 million seed this summer that will help us build out a plant that can scale to over 40 million bacon a year.
Great. Okay. You've got the numbers in your head. So let's pick a valuation. Pick a valuation. I mean, and we won't
Sure.
do this. What do you think you would, ideally want to raise money at?
Probably mid-teens is, I think, where
let's
we
say
will,
15.
we'll
Let's say
land.
15.
Yeah, about 15 this summer. Yep.
Okay. So at 15 in the seed stage, what do you think that means a VC needs to believe based on the slide that I put up? What does a VC need to believe that you have the ability to get to at the time of exit?
What, 1.5, right? Roughly, right? 1.5 billion, right? In terms of
on the 100x
potential
side.
exit valuation. Yeah.
Yeah. I think, if it
You mean
depends
in terms of revenue or?
no, well,
what
we'll
do
get
you-
there. We'll get there.
Okay.
Exactly.
Yep.
So I don't actually want to push you to 100x because I think when I look at 100x, sometimes we can round down and just say $1 billion.
Sure.
Let's say $1 billion exit.
If we do $1 billion IPO, I think all of our investors will be happy.
Right. Do you know what the mechanics are of deciding whether or not your business is what does it mean to be $1 billion business? How do people calculate that?
I mean, I think you look at it in terms of like enterprise value as a multiple of revenue or of EBITDA, and there's also a factor for growth and industry. It can vary, right? But you have to get to certain minimum levels of revenue with a certain amount of margin and a certain future growth potential, so that when you get to exit, whether it's M&A or public markets, the valuation is high enough that your early investors are all happy.
Yeah, amazing. Because we're usually when I do this exercise, if I don't have a guest coming in, I really push people to help or see if they understand what it means to get to a valuation off of a valuation multiple. But in the interest of time, I want to oversimplify what this means for everyone. When we think about valuing a company, we're trying to say, how much is this company worth? If I own the company in perpetuity to the future and took out all the profits and put it all together, what would all that present value, what would that be worth? And there's a lot of calculations you can do. Different businesses have different margins, et cetera. What ends up actually happening, and you ex-investment bankers can correct me or help me with this, but my oversimplification of this is finance professionals will come in and say, yeah, we could do all of these calculations, but to simplify it, we use something called a valuation multiple, which means we say, well, look, you are a CPG business. In the public markets, you are probably getting 3 to 5x your top line revenue. Yep. And obviously that is impacted by different things, but 3 to 5x. So let's go with that. For your specific case, Jared, let's give you on the high end, a 5x multiple. To get to $1 billion, what does that mean you have to be doing revenue wise?
Well, then we'd have to be at 200 million annual revenue.
200 million annual revenue. And how much are you retailing a package of your plant-based bacon for?
About $14 a unit right now.
Okay, let's say $20 a unit.
Sure.
Okay. So how many packages of bacon do you think you need to be doing a year in order to get that done? Let me do the math in my head.
Well, now I'm going to have to do that math in my head, right? It's 200 million over 20. So it's like
10 million.
10 million, right?
10 million packages of bacon a year, right?
Oh, yeah.
So in that future.
And by the way, we should get some credit for future products that aren't on the market yet. Bacon is the first of several and so on. But yes.
No.
Yes, you're right.
Actually, that's exactly the path that you need to be thinking about and the path that a venture capitalist is going to be thinking about, right? Yeah. So this is an exercise for everyone to put themselves in the shoes of a venture capitalist and say, well, what is going to go through their head? You know, if you're in the very beginning stages of something, they're talking to Jared, they're talking to Brianna, they're talking to Cody. Cody's only doing one little, one thing within cardiovascular health. And there aren't even that many people that do that or that experience that in the United States. Like when I run that math to try to figure out what you're worth in the future, how do we get to $1 billion valuation, right? So the point of all of this, and thank you, Jared, for volunteering. You're
sure, yeah. Thanks.
Well, the point of all of this for me to share with everyone is that if you guys go through this math, and you run through the exercise that a venture capitalist will be going through, you need to also understand what they need to believe in you and your vision and where this goes to be able to say like, yeah, this VC will meet Mauricio and be like squinting at what he's doing and just be like, you know what? Like, I know he's focused on something really niche right now, but he just like has that energy that he wants to build a gigantic business, right? This is the type of person that will land with the first product, understand a customer base really well, and then be ready and willing to continue to build more and more and more until the business is really big. So I wanted to start doing this series because I have a sense that a lot of founders who are great founders and great entrepreneurs don't understand what the bar is around being venture backable and how big they need to show up for themselves and in conversations with venture capitalists in order for people to be like, wow, there is an opportunity where there's a state of the world where I see Anastasia like going huge in this because she is so passionate about this space. All she wants to do is make the biggest impact that she can. Or Nancy is just an animal. She's built big businesses. And so the next business that she builds isn't going to be like a medium-sized business. She wants to go really big here. Like I pick that up. Like I picked that up in talking to her. And so these are all the things that come up. We are going to wait for Ellie to jump back in. I think she might have dropped and said she would come back at the half hour. But before we get there, I did want to tell you two things because some people had been messaging about this. Some of you came in because you're interested in learning more about the program that we run. I want you to know that we finally did announce that we are going to do another cohort starting May 22nd. And then we have an application deadline on May 10th. So feel free to check that out. It's fundraisewithconfidence.com. You can, if you could send that through the chat, guys. And then the second thing is all the way until May 10th, we'll be doing more of these. Like I said, next week, I'm going to do a workshop on using ChatGPT to fundraise. We're excited to kind of walk through a lot of the queries that we've been using to support founders, things that you guys can do yourself. As you might imagine, this type of technology cuts down on a lot of the manual labor that I had to do when I was fundraising myself. Okay, so before we wait for Ellie to come back in, we have a couple of minutes. Brianna, do you still have any questions around this? I want to make sure that we do a little interactivity before.
I didn't have any questions. I think you had posted or you had asked if anybody was willing to share, and I said yes.
Oh, okay. Your hand was still up. I might actually come back to you.
Let me. Oh, I don't know. Oh, maybe there you go. Lower hand.
There we go. Mauricio, hey man, I see your hand raised.
Yeah, no, I just wanted to share that during your example with Jared on the bacon scenario, it also all made me think on the reverse engineering. So he needs to sell 10 million pieces of bacon. And is his ask linked? Like, does he have the infrastructure to do that, to be able to obtain that and everything that comes along with the added return? So will this be done in 1 round, 2 rounds, and that will also impact what the VC has in mind as well? So I think it's important.
Yeah, I mean, the fact of the matter is, and there's Ellie, the fact of the matter is, there is so much between today, Jared, and 5 to 10 years IPO, Jared, right? So it isn't actually like that tactical around like, oh, like, will I test Jared today about what does your supply chain look like? Or like, what does your supply chain in the future look like? It really is just to get a read on whether or not we think this is the type of person that is going to figure that stuff out, that is going to push them, push the company forward. And so, Mauricio, thank you for asking that question. Everyone that engaged on that first part. I'm excited to say that Ellie Wheeler has joined us. Ellie, how are you?
I'm good. How are you? Good to see you.
Oh my gosh, Ellie, it's been so long. I want to give a short introduction on Ellie Wheeler. It could go much longer because she's had pretty impressive career, but we are friends and old colleagues, which is why I was able to get such an awesome VC to join us. Ellie Wheeler is, sorry, I'm going to have to get a charger in 1 second. Ellie Wheeler is a partner at Greycroft. She has led some pretty incredible deals. Nom Nom Now, actually, I guess it's called Nom Nom, sold to Mars. And I don't think it was explicitly reported, but I saw reports of $1 billion sale to Mars. She was the lead on New Order, which sold for about $500 million, and a lot of other amazing deals. Ellie, are you still in New York City?
I am. I'm here in New York in our office today.
Holding it down. We just got through 30 minutes of talking about this idea of being venture-backable, exciting venture capitalists, and seeing how they think about deals. Whenever I get a chance to talk to a VC and get them to share a couple things with a community of founders, I love just like diving into hearing about personal things that excite you, right? Like every VC has seen things in their past, have patterns that they match against. But if you think about the things that get you excited when you meet a founder, like small little details that can get you to lean in a little bit further, are there any things that stand out to you or that you're always looking for?
Yeah, It's a good question. Yeah, there are certain types of founders that are just better fits with individual investors too, right? So,
Yep.
I care a lot about really deeply understanding the problem you're trying to solve. Some people call it founder, kind of founder problem fit, or there's various ways of saying it, right? But deeply understanding it, having whether it's domain experience or something specific, such that you have an insight that's unique, that's different, that's something you're going to be able to really build a sustaining company against. Because ultimately, all the other things have to be there too, in terms of just kind of market size and opportunity. Because as we're evaluating something, we need to believe that it can be a standalone, multi-billion-dollar opportunity, right? So how do you figure that out in the early days? Oftentimes, it really is about founder. So I care a lot about their understanding of the real intricacies of the problem that they're solving, why they're uniquely suited to do it, and a lot of that comes out in the back and forth around, what it is they're building and why. Oftentimes more on the why, since the what will typically adjust and change.
I'd love to double click on that, because when you talk to VCs, that first answer that you just gave is pretty common, right? It'll come out. If you went to ChatGPT and you asked them, what would the VC answer to that? It would probably be that. I think you have, I think you have a lot of, personal stories, and I'm going to let you, I'll give a few words to let you start thinking about this, but I wonder if you can think about one of your investments, and if you remember any of the initial conversations from a founder where, it could be Walter Driver from Scopely, it could be the founder of Nom Nom Now, or any of the smaller deals that you've done, even if they haven't become big yet. Can you tell some stories with or without names, but of an interaction, an initial interaction that made you kind of raise your eyebrow, or it's something that really stood out to you that was man, this founder gets it, or has a unique insight, anything like that?
Sure.
And while you talk, by the way, I'm just going to get a charter, so don't get distracted by my.
So I'm an investor in, and we invested in the seed round of a company called 30 Madison, which is kind of a consumer health platform. It's multi-branded, but really it ranges from low acuity to high acuity. They have multiple brands. They've got a consumer business, but increasingly they have a payer business, because it's a healthcare business, not a CPG business. There's a few different platforms. I think they all fall somewhere different on the continuum of CPG to healthcare. I think personally, 30 Madison is the farthest toward healthcare, just more complicated and higher acuity conditions that they're covering. We invested in the team who had worked together before, pre-launch on a slide deck. And we've been in every round since. Now their value, their unicorn, what have you. But in the initial meeting, first of all, they had a great rapport. They built something together. They sold it to Google. It wasn't a huge home run, but they knew how to work with each other. They knew what they were good at. So that's always starting somewhere. And it was right at the beginning, timing wise, as I was spending more and more time in and around health tech, and just believing that there was an intersection, finally, after decades of talking about it, the intersection of consumer and healthcare was actually going to be real. Not that the consumer was going to pay suddenly for healthcare out of pocket, but rather that the customer experience and the best practices of consumer could be applied in really meaningful, valuable ways to healthcare. And they initially pitched a company that was called something else, Samson, which is named for, God, I'm certain someone on this call will have a better understanding of this than I was, but it's named for a Bible story of Samson who I guess lost his hair or something. And it was a hair loss business. So that business, but even at that time, when they called it Samson, which is a horrible name, don't worry, they didn't launch with that. They had this broader vision around, this is going to be one in a series of brands that's going to be on a platform. There are multiple reasons why it actually makes sense to have disparate brands on a platform, but they had a much bigger kind of plan and dream of why this company was going to matter in a scenario where it worked, right?
Yeah.
That's often a question I'll ask, like, how is the world going to look if everything works? And what's going to be different than the world is today if everything that you do, like, assume wild success, right? And then tell me more about that version of the world, which I thought they did very well and shockingly in line with what they ended up doing. That's unusual. Typically, there'll be at least a 25-degree change in direction over time. It's not like everything was perfectly up and to the right. I mean, everybody has their challenges, but remarkably consistent. And it also, importantly, happened to be right along the thesis that I was operating on at that time. So sometimes it's kind of a mind meld on finding the founders who have this vision of the world, are working on that, have a good working relationship. You believe that, they can actually execute against it, having learned lessons in the past. And then it also being in an area that you're particularly excited about and want to spend, 10 years building.
Yeah. I think it's important to just highlight for everyone, because we just gone through this exercise of thinking about the math of a CPG business and how it starts, but how it could be even bigger and bigger and bigger. And, what Ellie just talked about was a team that had talked about an initial entry point, but when pushed about what are they trying to build, they didn't make up the things that they had thought about on the spot. They had been thinking about their entry point was just a toe in the water, their initial foray into building a gigantic business, things that could be layered on top of a platform, et cetera, et cetera. And this is the distinction between a lot of great businesses that have this sense of, well, like, I could build like a $50 million business, a $100 million business. And if you talk to Ellie with those dreams, like, she'll be very complimentary, I know, of your business, but she probably won't be interested in investing in that because, like we went through, it just doesn't fit her business model, right?
It's just fun math, doesn't work.
Yeah,
and the other thing that they had that was a unique insight at the time was a belief in the power of marrying a product and a service, right? So at the time, this is now, I don't know, 2016, 2017, it was still the heyday of consumer subscription, like CPG subscription, stuff in a box, which, had its moment and then didn't for a whole bunch of reasons. But, they had this thesis around, actually, this can work and it's a much better business if you actually marry a service and a product together for a million different reasons, including gross margin. But, anyway, that was just kind of an additional insight that they had at the time.
Nice. I wanted to shift us over to another topic, obviously related to, but around what the last year in the venture market and the startup market has been like. It's been from my side and just observing it, has been a crazy roller coaster from the inflated highs of 2021 all the way through Q1 2022 to crazy disruptions to the market, huge failures, crypto crashes, important bank failures. So along the way, I think it's really impacted the way venture capitalists think about valuing companies. But I think you have the benefit of having a 15-year career within venture capital to understand just the highs and lows. But a lot of founders, including ones on this call, have only a short window, right? 2 years, maybe 3 years, maybe they just jumped into it. So as the market settles, I don't think we have a fat enough market right now to understand. Just wanted to get your sense for what you're seeing in the market and how you're approaching things like valuation and talking to founders around both valuation and how much money they should raise at different stages, because I think it's a very confusing question for a lot of people now.
Yeah, it is. First and foremost, just in terms of level setting, right? The aberration was 2020 and 2021.
Okay.
Right?
We'll go back to that. Yep.
Yeah, that was the aberration. And just in terms of round size and price and velocity of rounds. People don't raise every 6 months. Like you're actually supposed to be de-risking the business from round to round. That's why you're getting paid a higher price. You have de-risked something from stage to stage. And there's always pockets of the market that are overheated that are super exciting. And right now that's AI, right? It is 2021 still in AI. And then there's the rest of the market is settling and pieces of it are completely dead. And will that be forever? Probably not. Forever is a very long time. But there's still a lot that has to shake out. And the most activity that we're seeing is in the earliest stages. So, still ideation, pre-seed, maybe seed, the definitions of all of that have changed pretty dramatically. What we're seeing very few traditional A rounds at the moment, with the exception of, outside of AI. You're seeing companies that raised $3 to $4 million seeds raise second seeds. So they're calling them all sorts of different things, but they're raising another 4. And that's a pretty significant amount of dilution, doing 4 and then 4, because it's typically flat to that round if they raise 4.
So it's like raising 8 at that same valuation.
That's right. But you're still in business. So, it's they've got hopefully another 18 to 24 months to be able to go execute, because what happened to a lot of companies that raised a seed in 2021 is they executed well, but the goalposts changed.
Yeah.
It's not like they didn't do absolutely everything they said they were going to do. They did. It's just that nobody cared, because the bar for what was fundable changed. So that's what we're seeing a lot of. And we're seeing very few kind of what you used to see, 10 on 40, even $15 million A rounds.
Yeah.
Really hard to come by.
Huh.
They just don't really exist right now. Now,
I think
there's like the second half of this year is going to be busy for a whole bunch of reasons.
Ooh.
Largely because all of those 2021 companies that have stayed out of market, it's now been 2 years, and they're going to be forced back in. So that's going to lead to a lot of interesting opportunities, and some companies that are going to not be able to raise, that are going to be pretty meaningful companies. So there's still a lot of that to come. I think the second half of the year is going to be, it's going to be busy. It's going to be noisy.
Interesting. I think one of the things that you said at the very beginning of this part, which is important for people to realize, and I hadn't even thought about this, is that it's still 2021 for AI companies, where it's an overheated space because of all the excitement. And what I take away from that for a lot of the founders here is that a lot of you who aren't AI companies, you might hear about rounds that are done by AI companies, and you might think that you should be sort of benchmarking yourself or what you're able to raise at valuations off of that. And I just don't think that's a very healthy or smart way to think about your rounds. Like, stay in your lane, like understand how much you need to raise. And just because an AI company is trying to raise a $5 million seed doesn't mean, your enterprise SaaS startup at a pre-seed or seed needs to do something similar. I want to make sure that we field some questions from the audience, because a lot of people have submitted some. There's a question from DJ, and I'll let DJ. Can we try to pin DJ up here? I'll restate it, but DJ asked a little bit about defensibility as you think about investing, and I think it's specifically interesting that he is curious about it at the pre-seed stage when it's so early, right? And defensibility becomes maybe something that's important. I think, like, if you could be brutally honest about the idea of defensibility, where does it rank when you're meeting a founder that's super early stage pre-seed? Like, how does defensibility register for you, Ellie?
It's way too early to be real. Now, it doesn't mean it's not something you think about, but it's more of a, in a vision of the world where this works, can this actually be defensible? Or will there be 100 companies doing exactly the same thing because there's no data loop that's actually making this product better today, better tomorrow than it is today? Or that they're only competing on price, or, you know, various other things that you can start to think about and say, okay, even if this does get to scale, is it going to, you know, is it going to be a really valuable business? So certainly think through it, but I don't expect it at the early stage because it's not possible. It's not, well, maybe it's possible in certain circumstances and hard tech and what have you, but it's not plausible.
DJ, is there a specific situation that you ran into that made you think about this?
Yeah, so we are working on creator economy space, and we are trying to build an option. We are trying to essentially create a Shopify for creators, right? So, and now the way the whole ecosystem has evolved over last, let's say, 18 months, especially with Instagram and Twitter now allowing, for example, subscriptions. So everybody has now sort of focused back on creators. So the incumbents are also fighting, and the new guys like us are also fighting. Trying to get into the space, right? So I'm just trying to think, you know, position ourselves and saying, okay, if I were to stretch myself out from 3-year point of view or 4-year point of view, and then see how are we going to fight the incumbents, right? And how do we build that defense mechanism? I'm coming more from a business angle, not from a capital raise point of view, right?
Yeah.
And therefore, capital is an important element from defensibility, at least to fight back. But even if we had capital, how should we think about it? So I wanted to get more perspective on that, to be honest.
Yeah, so great that that's your approach to thinking about the idea of defensibility, right? Like you're not actually thinking about defensibility, you're thinking about viability, right? Like it's like, can your business actually survive or stake a claim within this world of like these big players? And I think,
what is your right to win?
Yeah, exactly.
Right to win, yes.
And I thought you might go down a different road of saying like, well, we had a venture capitalist say that the reason they didn't invest is that we didn't have great defensibility. And what I wanted to call out for people is that I 1000% agree with Ellie. And honestly, if you hear a defensibility reason for passing early on, it falls into that bucket of not really. They just weren't excited about your ability to win, right? Like, because this is a 10-year investment, like a lot of things have to play out, and a lot of gigantic businesses have been built in spaces where there are huge incumbents that could technically have done everything that you did. So it's defensibility is, you know, it's too early, and it's just something that, look, are you a founder that will be able to figure it out and be strategic in the future and make the right moves in order to, you know, grow while incumbents don't see you and then take over their launch as you overtake them? So thanks, DJ. I appreciate that question. Let's see, we have 10 more minutes. Okay, so there are a few questions about round sizes, Ellie.
Okay.
And I think when we think about 2020 and 2021, like speed of which people were raising, the size, et cetera, all that overheatedness, I think it really did affect how people thought about raising capital. At the same time, like I have the same question too, right? Like inflation over the last 3 years has been crazy. So it does cost more money to hire great engineers or great people. When I was running a company, we could hire some great engineers between 100 and 125K, and it's just like not possible anymore. So if you finger in the air, like pre-seed rounds for software companies, you know, where do you see, what do you think? And we won't hold you to this. I'm just trying to like get a better sense for where these round sizes are running. But like, if you're a software company that is, you know, trying to build their first round and first product, like how much do you think they should be able to do that on?
It's a good one because the answer, of course, is it depends.
Good
You know,
answer,
it
good
depends
answer.
what it is that you're building in order to actually get to that back into it. If you can only, part of it is take as much as you can get. You know, I think people over optimize. Most people don't have options. Most people aren't fending off a bunch of, oh, I've got a $3 million term sheet, a $5 million term sheet, and a $1.5 million term sheet. Well, that would be a great position to be in, and that is not the reality for most people. So it's about really setting the expectations up correctly for whatever that amount of money is, right? You're obviously not going to be able to prove out the same number of things on $5 million as you are with 600,000. As long as you are eyes wide open, and so is your funder, about what you're de-risking along the way. And if it is enough to unlock the next tranche of capital, like that's actually the bigger question, is what is enough to unlock the next phase?
Yes.
And it gets back to what have you de-risked? And, you know, in some cases it's, hey, this product is hard to build and this team is working so well, they're actually shipping super quickly. And that velocity in the early days is really indicative of a lot of positive things, right? So that might be enough. But more often than not, it's also, it's on the commercial side, it's on the go-to-market, it's on the distribution side. And are you going to be able to de-risk that or not?
Yeah, I think the framework that I push founders to think about a lot that you hinted at is important for everyone to hear, because I think a lot of founders don't do this, which is when you're going to raise a round of capital. Let's actually take a step back. When you're deciding to be a venture-backed business, you are getting on a train, right? And that train is heading to either gigantic outcome or nothing, right? And so at each fundraise, you have to be thinking to yourself, what is the next thing that we're trying to do? Are we trying to raise another round of capital after this round of capital? Or do we think we're going to be profitable, but that being profitable still has to come with the right growth metrics. But those are really your only two options of saying, we're raising money to raise more money or to be profitable. And too few founders I run into think about that when they're like, this is how much I want to raise. They're thinking about what they've heard in the news and the media of how much people raise. And they're like, oh yeah, finger in the air, $2 million, because everyone's raising $2 million. I think what Ellie talked about, which was this idea of like, what is the milestone you want to get to? And even further than that is like, okay, you can come up with milestones, but realize the milestones that you come up with have to be milestones that you think could convince the next round of investors to actually pile in. And so if you can start thinking about milestones from that perspective and then work backwards and say, okay, can we get there in 18 months? If we want to get there in 18 months, how many people do we need to hire? How much spend do we need to go forward? Make all those calculations come together, gross it up by, 50% for a buffer. That's kind of how I think about it. I know a few people asked that question. So that was great. Is a team with Bot Factory here?
Yep.
Okay. So you want to ask your question? I think Ellie will have a quick answer to this, but it was about valuation and revenue.
Yep, correct. So I guess the question comes from, it's a similar situation to what Ellie was explaining. We raised at a valuation of 7 several years ago, I'm going to say 4 years ago, right? We want to do what I would consider a smaller raise to untap the next goal of the company. And we have 1.5 million in revenue from last year with some profit. But what I'm finding is investors coming back at trying to do the same valuation, but just the multiplier doesn't pay out, because I'm saying, okay, that was 4 years ago. Next raise is going to be a couple of years from now. I am growing. It adds to like at least 5 cash return plus, the value that we're expanding. So how do I go about kind of going back to defendability, right? How do I defend an increase on the valuation based on revenue, operating income, and actually new marketing on that?
I think
It's
you're
gonna be a
gonna
harsh answer, right?
Yeah, I don't know if you can, quite honestly. You're not gonna like the answer, but if it took you 4 years to get to this point, what you need to demonstrate is that the go forward is going to be pretty dramatically different. It's not going to take you 4 years to get to 3, right? So there has to be something that you've unlocked that's going to fundamentally change your trajectory, such that you're going to be able to see that this can be venture scale. Right now, it's not like nothing ever changes. Of course, there's exceptions, but the fact that it's been a few years, it's not going to help you. It's going to hurt you.
Yeah, I want to put a concept out there, and maybe if anyone wants to raise their hand, we'll end on this, because a lot of this conversation has been around valuation, especially as markets have changed and gone up and down. But does anyone know the simple answer to what is anything worth? Does anyone want to chime? Yeah, Ellie, what's something worth?
What someone's willing to pay.
That's right. So
You got the answer from the
yeah.
market.
You're right. So what we're talking about when we look at fundraising and what you guys are going out valuation wise is the market is going to dictate what you're able to do. Obviously, you'll do things to influence that. You'll try to create a market. You'll try to create a fat market as much as possible so that you can get to the optimal ending point for yourself. But at the end of the day, your valuation is only what someone is willing to pay for it. And the bot factory team, the market could have been very different when you raised before. And whatever happens today is just like, you're not going to be able to do a math equation in order to spit out something that people will, actually embrace. You could try to influence them with that, but it's only as good as something as whatever the investor is willing to pay. So perfect timing, Ellie. Thanks so much for finding the time. I know your schedule is super busy, but this has been really great. We've talked a lot about what everyone needs to understand in terms of this market. And we'd love to have you back at some point. But if I'm in New York anytime soon, I'll certainly look you up. Okay.
Definitely do. Thanks everybody.
Ellie. Everyone, feel free to drop Ellie. Everyone, next week, we are going to be talking about ChatGPT and fundraising. So the team has been working on different ways to support founders with access to ChatGPT. That will be next Friday. Let me put that up in case you guys want to see it. So next Friday, using ChatGPT to raise, we'll also be talking a little bit about the FWC program. But other than that, I hope you guys have a great rest of your day, and we'll see you soon.
Thanks, Jay. Yeah.
Thanks, Cody.
Thank you.
Cause